David Bastian, Kingdom Capital Advisors. We've had a lot of SaaS. I like retailers and commodities, so this is going to be a little different. Children's Place. They sell kids' clothes. This is a very simple business model. They've done $1.6 billion of revenue in the last 12 months. They have 600 physical stores, and half their sales are online through their own website. About 20% of their e-commerce is also through Amazon. They bought Gymboree out of bankruptcy in 2019. All right, cash flow. Here we have what all of us want to buy, which is a company that consistently, profitably operated for most of the last 15 years before having 3 of the most volatile years in their entire history in 20, 21, and 22. So, as you can see here, EBITDA, about $200 million a year. Cash flow averaged $100 million a year. Then they had one really bad year. Then they had the best year in their history, and then they got a bad year again last year. Last year was all freight and cotton. This company has taken every dollar of free cash flow in their last 15 years and returned it to shareholders. This is what we're all looking for. As you can see, $1.6 billion of free cash flow, $1.6 billion of capital returns. All right, Children's Place. Many of you probably have not heard of this company. I have 3 children under the age of 4, so I am familiar with them. I don't expect you all to be. Their target is millennial moms. Therefore, they're on social media. So if you're on Instagram, this is where you're going to find them. They're dominating Carter's, Old Navy, Gap, all the brands you see on here. Children's Place is at the top of the pile, and it's not particularly close. Google Trends, for anyone who likes using this. As you can see, they hold up just fine versus Carter's, Old Navy, and Gap. You can also see 2 very notable spikes for Children's Place. They are very good at back to school. That is their best quarter, Q3. All right, so now we're looking at this thing. We're saying, all right, out of the last 3 years, 2 of them have been bad. One of them was COVID. We understand that. Last year, we're trying to figure out, did this business break? We have 2 key things that happen. One is a spike in cotton costs on the left. Cotton more than doubled off the bottom coming out of COVID. Secondly, we have ocean freight. That's ocean freight doing a 5x into 2022. So we look down here at the bottom. Children's Place is a 35, give or take, gross margin business. They've had some issues. If you're looking at this business from 2019, you might think, okay, there was a little bit of an issue there. Numbers were down a bit. Gross margin wasn't quite as good. Well, they were competing with price with Gymboree and forcing them out of business. Gymboree liquidated, and they bought them for $75 million. That was over $1 billion of product that hit the market. Still a 35% gross margin business. COVID happened. Then 2021 happened. Amazing environment for retailers. These guys made bank. And then last year, cotton and freight was a 7.3% headwind on their margins. All right, the key thing you can see here is that the freight is back at the normal levels. Cotton, back at normal levels. Children's Place, there's about a 9-month lag between when they buy their cotton and when it hits their P&L. That's happening right now. So, why does this opportunity exist? 1, there's debt. These guys are sitting on about $400 million of debt if you pull up their financials right now. That can be scary for legacy retailers. Well, this summer they went out and expanded the facility by $100 million. PNC gave it to the money at SOFR plus 2, which is not distressed. Most of my microcaps would love to get money at SOFR plus 2. They also got it written into their credit agreement that they'll get it back to SOFR plus 1 when their EBITDA hits $200 million again. So the lenders are not concerned here. The company is guided to $170 million of paydown by the end of the year thanks to back to school, which just happened, but isn't in their numbers yet. Next, we have margins. These guys have historically had good margins. If you look at last year, their gross margin was 37%. Once you adjust for cotton and freight, they were doing fine. That was a year which, if you recall, Target and Walmart were liquidating inventory at an insane pace because they overbought. Children's Place is not there, but they compete with them. That's all Carter's. All right, these guys competed with price on Gymboree in 2018 and 2019. They knocked them out. They bought them. Amazon right now, if you look it up, they're pulling back on private label. Children's Place is going on to Amazon right now. It's their fastest growing segment. Margins are okay. Capital allocation, as we highlighted, these guys do one thing with their capital. It's buy back stock. That's awesome. when your valuation is low. That's what it is. All right. So the CEO this summer bought $1 million worth of shares. First day their window was open. They have one project left they want to do, which is bringing the rest of their fulfillment in-house. Right now, about 40% is at a third party. That's going to solidify margins. It has a very short payback period. Everything else is going to buy back stock. Fear, recession. Pull up 08 and 09 for Children's Place and Carter's. They grew sales. Kids don't stop growing in recessions. I have 3 of them. We're also not in a recession. I'm sorry to break it to you. Mall-based retailer. Children's Place has 1,000 stores in 2018. They now have 500. Their leases are less than 2 years. They took out half their store base and moved those sales online. They went from almost no e-commerce sales to over half their sales are now happening online through their own website. This is almost $1 billion e-commerce brand. They're doing okay. They were in front of the trend. All right, so how do you make money? Cotton and freight, we've lapped that. So, Children's Place is returning to their cash generation ways. They've got to do $160 million of free cash flow just in the back half of this year as back to school and holidays lap. They no longer have high cost inventory because cotton prices are down. So then we have next year. They're going to be doing buybacks because their debt's not going to be a problem anymore. They'll be one-time levered. This business did $100 million of free cash flow every year for over a decade and grew during our last recession. You can buy it today for a $300 million market cap. And all their cash flow is going to buybacks. Have I mentioned that? What's going to happen once they stop paying off the debt? So we have a proven business model with scale. They've taken out their competitor, Gymboree. All their cash is flowing in right now. They have a proven history of buybacks. Management has demonstrated alignment and bought $1 million worth of shares this summer. Unlike some retailers that actually have problems, Children's Place has one problem, and that was cotton and freight spiking. That is over. Their gross margins were fine last year, and they will be fine again now. In summary, Children's Place is a very good opportunity right now, and I like it a lot. I have 3 minutes for Q&A. I've got a question in the back. I mean, you can look at birth rates. They're down a little bit. I'm doing my part. There was a marriage boom coming out of COVID. There might be some kids following that. At the end of the day, there are still a lot of children in the world. If the birth rate is declining by 1% or so. They wanted to go from 1,000 to 500. They'll hit 500 next year. They don't want to go below that. They think 500 is the right size. Yeah, they're buying back shares starting January of next year, give or take a month. Gymboree had their own stores. They completely liquidated. Children's Place bought the brand, and now they just sell Gymboree products in their stores. There are no Gymboree locations left. Good. I think it's somewhere between 3 and 4 times. It's a little bit messy with the spike in inventory costs and stuff. Yes. They historically have run with a small amount of debt. Then last year it spiked into this year about to $400 million, and they'll be back down to $200 million thanks to their working capital finally giving them a break this year with cotton and freight. It's levered 1 time, and they're paying SOFR plus 1 once their EBITDA comes back. So it's actually fairly healthy leverage in my view for a business that's consistently done $100 million of cash flow in every instance other than COVID. I am wearing a Children's Place t-shirt today, which my wife brought for me when she was shopping it for me to let me know if it was any good. So they do not age out. Right here. 75% or less than 2 years. And how much are those leases going to be going up over time? Most of the malls I follow say that they're giving people concessions to stay in their stores, so I think they're going to be okay. So most of the fulfillment is their Alabama distribution center. It grew so fast that now they're using a third party for about 40%. In terms of margins, e-commerce and Amazon are both lower gross margin and higher operating margin. They're both double-digit operating margin, according to the company. You'll notice even last year they were still at 37% gross with their margins even having grown their online segment. So I think they're doing fine on margins, just caught in a freighter of the issue. Yes.
Thank you, David. Round of applause.